let's have a look now technically. Okay, what the technical analysis tells us. So that was the pre-crash in 2000 level. Okay, and then $1.6 somewhere here, and then nice growth. Okay, and that's where the highest point, $92, and that's a drop. Okay, to $44. And we can see now that it's done like nearly 3 even rolls, kind of like that, or you can make it as a one roll. Okay, so it's one roll, the second roll. So, and if we expect, it can go and do the third roll. Okay, something like that. Now, of course, it can break through, but we can see it's kind of uptrend. We can see that it was the highest low and it was highest high. Okay, and that's why I put this trend. Of course, it might break through if something happens, and next support would be around 45 probably here. Just a second. So it would be on the same as here. So I don't see it now, but we'll have a look. Okay, the interesting thing about it, let's have a look how often we had a situation like that. Look indicators, right? So for example, if we look at RSI, so we see it below 30, right? Before it was here, and then here, and here. So that's what we can see. For the last 10 years, that low, it was only twice. Here it was a move, okay? Here it was a move, okay? And here it was a slight move as well. We don't see how much is that happened, but definitely a move. So if we look close to this number, 1, 2, 3, right, more. So here was a move after that. Here was a move, and here was a move as well. So it tells us that historically, the situation like that, in oversold situation, it happened only several times. So once in several years, opportunity like that. If we look at another indicator, stochastic, right? So similar situation, 1, 2, okay, that's the growth. Here, the growth. Okay, we can expect a closer here on this level, so after which is also was growth. Here as well, the growth after that. Here, the growth. Here again, the growth. So each time when we saw something like that, the share price moved up. Okay, and then MACD, actually MACD in red zone was only in 2008. Right, all the rest it was in green zone, and now we can see it went up and again in a red zone. So it's quite seldom situation like that happens. And now we can see 3 indicators, 1, 2, and 3, they all align. So what does it tell us? What do you think? If we use only technical analysis, is it a good time to buy or is it a good time to sell? Yeah, you can buy. What means buy short? There is no buy short. You can buy, but when you buy it, it goes long. Like if you're talking about shares. If you sell short. Okay, let's have a look at the closer picture. So that's the last trend which we see in this part. Okay, so that's what we can see. So it was one roll. It's kind of moved up again. It wasn't complete big roll here, and then it's done another roll. Okay, and that's. Do you think now, based on indicators or anything now, is it a good time to enter long position or not good time to enter long position? No, correct, Dory. What price would be preferable compared with now? We cannot tell exactly because we don't see, but if we look at the trend, where do you think the price can be? 52, correct, Dory. Yeah, absolutely. So somewhere here, right? Somewhere in this area. It might never get to this level, same as here. You see, it was going here, but it didn't reach this point. So it might also be kick up here and move up. Yeah, similar to what was here. But maybe it will go down here. Indicators, they don't show a specific right? So at the moment they're kind of on the high, and here in the middle. So it doesn't tell us anything. Whereas MACD is pretty well. It shows already divergence. So we can see that MACD, they kind of start lowering down the sticks, yeah, but the price is still going down. So it's a divergence. So it's a good opportunity. It definitely tells us that it's approaching the time when the price is going to remove. But definitely, I agree with Dory that we're going to look somewhere at 50, like $52, $53 level, something like that. Okay, if we get into this position, where do you expect the price will go? Okay, if it goes up, where will it go? Okay, 59, 59, it would be here, right? So that would be in this trend, correct? So if you buy and sell here, and if we look at the longer term, so we can go next. If it breaks $59 resistance, where will it go? 69, correct? So that would be this target. So if we look at this trend, right? So it's going to about 71 or something. Now also, if you put a parallel trend here, line, so something like that. Okay, maybe not straight, but like that. So we can see that several times it's one, like was holding several times, 1, 2, 3, 4 times here, right? Here it's broke through, tested, went down. Here one more time, again down. After that it's broke through, it becomes a resistance, you see? Here it's tested twice again, and then it's went down. So that's why I presume one of the levels, resistance level, will be somewhere here, around $64 level. Like you have to look exactly specifically where was the prices here on those dates, and but it's around $64 level. And if it breaks through, it's again $69 to $70. So that's what you can expect. And if it breaks through there, it's already going to go 100 and etc. Okay. So okay, do you understand where they're coming from? Yeah. So whatever was resistance before, it might become a resistance again, and it also was a support here. Okay. So it's kind of pretty strong level. So that's why I would pay attention definitely to this particular level. Okay. So based on this, we have several strategies. So first strategy based on fundamentals, it's value investing long term to buy and hold strategy. So we can buy, and of course, like we put it 51 to 53. So as Dory said, about $52 level. If you see that it's moving down, let it go. I mean, let it go even lower, because it's quite easily can go to $48 level or even lower to $44 level. Who knows? Like, I mean, market is unpredictable, and it might give us, because at the moment the whole market indexes are high, and like last night they start moving up. That's why share was moving up as well. But if tonight or next week the indexes will go down 5%, it might go 5% down. 5% down here, it's like $3, like nearly $3, like $2.5. So that will give you the opportunity to buy it at $52 level instead of 55, which is pretty good. But if it moves even lower, so it might give you even better opportunity. You might buy it at 48. Okay, so something like that. So definitely have a look. Now here you would need to wait up to 3 years, based on value line analysis, based on their revenue, and when retailers in general improve. And it's actually at the moment right now, and you will see that a lot of talks that retailers are going to improve among investors, because confidence among public that economy is going to prosper, and people confident that they're getting jobs, etc., etc. So I assume that retailers, they're going to move up. Actually, nothing which I wanted to show you. Look at this. If you look at this trend, what happens faster, growth or fall? Is it? Dory, look at this. How fast is the growth? And then that's the fall. The growth and the fall. The growth and then the fall. So what can we see? Actually, the growth is like here, the part of the growth happened quite quickly. So that's usually it's vice versa. Usually you see the longer upside and then the fast fall, okay, and then again longer upside. So here we can see quite fast go, and I would love to check it, but I presume that's all earnings, all these points, and they're going to have earnings 20, I think 5th earnings 25th of July. So pay attention to that. Okay. Now, usually what I notice like that, when investors, they believe that it is a good company, and but they're afraid of earnings, they're afraid of previous fall. But whenever good news come up, they start jumping on it and buy it, and that's why the growth happens quite fast. And then they don't want to let the company go, and that's why it's kind of slow to deteriorate in price. Whereas the bad companies usually, if people own them and they start falling, they're afraid that it can go to zero. They start selling it quite quickly, and that's where the fall like that happens. Okay, here it was January 2016, this area. Remember last year when everything was falling, Nasdaq went 18% down. So I presume that's where this company fell quite a lot as well. But it was at the highest at this moment. Okay, remember. Okay, so that's one strategy. In this particular case, you buy it and you hold it. Now imagine we're looking at one company every month, and if you devote some money and spread your investments and choose maybe out of this 12 which we analyze, maybe 6, so you can buy every second month one company, and you will have 6 companies in your portfolio during a year. And if it goes and make 100% during 2 years, so it means that in 2 years time you will free your cash, and after that you will use the cash which you receive. So you can rotate the money which you invest. Of course, if you look at some companies which we analyzed already in our classes, like for example Nike, right? What happened to Nike? Nike, when we analyzed it, was around $51. It went to 60, so it's made 20% growth, and now it's back to 51. So now we can buy it again. So whoever bought it and made money on it, now you can use it again. So every time you can, or remember, company we looked, what was that? Skechers. Also Skechers moved quite high to around 30, then it went to nearly 22, and now it's moving back up, or like somewhere there. So you can make it. The question is, who made the trade on the last company which we made in CVS Health, last masterclass? What did you make there? So did you sell it, Dory, when it went up, or did you keep it and now you're enjoying the fall? Still on it, yeah? I bought it and I sold it, and I made 37% profit on the trade. I bought long call, you bought shares. Okay, I bought long call with the $80 strike price and sold it when it went to $80. When I saw it start moving down, I sold it. So that's the trade. And now I have an order to buy it again. But technically, it's not the perfect time, probably right now to enter a position, but yeah. So the reason why we're doing this master class is because you can analyze these companies and you think, okay, fine. So this company is good, but I'm not happy to hold it for, let's say, for 3 years. What am I going to do? I'm going to buy it and sell it at, for example, $65 level or $64 level, where we saw the previous resistance was. Okay, you buy it, you sell it, you exit it, you have cash. What are you going to buy? What companies? And here, if you have a list, you have Nike, you have Skechers, you have like Apple, you have anything, and then you can see, okay, I have 20 companies in my list. Which company right now at support? And that's where you purchase, and you already researched them. You don't need to research them deeply again because you've already done that research. So that's why we're doing only one company a month, which is more than enough for like proper investing, because it's much better to buy a proper company once a month rather than a bad company like every like let's say week. Okay, so that's the thing. All right, so another strategy which we can use, roll strategy, as I said already. So you buy at 51, 53 and sell at 65, 69, 70. Yeah, correct, Dory. You need to make a Excel, or you can do it in your like interactive broker account. Can have quality companies and put it there, all right, and have it there. So then the next strategy is BR strategy. So you buy shares. Okay, we're going to look at example now at current prices. If we buy right now and we sell a call right now. But again, it's much better if you buy at support and then you sell call when it comes to resistance. All right, so that's the thing. And you can expect here to get 1.5 to $2.5. So it's about 2.5% on the rent profit. Okay, then you can sell naked put. So naked put, if you don't want to miss an opportunity and you decide to sell it, so you sell it at $50 strike price, but again, not at right now prices, because we expect that the share price might go down. So, but try to get maybe $3 or $4, maybe on more. So, and then if the share price moves up, it's up to 8% profit on the trade, so, which is fantastic, right? So, and if shares put to you, your break even would be much lower, around $52, $50 level, so which is much better. Now, last time we looked at LEAP call options, and they were quite good, and I bought them. That's why I chose LEAP call options last time. But this time we're going to have a look. Are they good for this specific company or not? Okay, so this strategy, again, remember, before you place any trade, you have to fully understand what you're doing, all right? Because it's your money. You invest your own money. You earn them, so you work hard for them. So make sure that you analyze 10 times and take into consideration your personal circumstances when you do it. So, okay, let's have a look at selling covered call. So what is happening here? So I look at this trade, the stock price right now, it's 55.75. And look at the strike prices. Do you think it's a good gap? Like, I mean, good distance between strike prices, $5, or is it bad? Yeah, definitely bad, not good, right? So another thing which I look at the spread between bid and ask. Is it a good spread or bad spread? $2 and $2.90. So we're looking at penny difference, or like cent difference. So when it's 1-2 cents, maximum 5 cents. Here it's 90 cents. So if you decide to buy this call and then instantly sell it, you're going to lose 90 cents right away. So it's not very good situation when we see something like that. Okay. And another thing, it's closed by yellow line, but that's open interest here, 120.24. And usually open interest for the companies which we are looking for has to be more than 1,000. So preferably. Now, open interest at how many contracts opened right now on this particular trade. And we can see it's quite low level. So that's why, because open interest is so low, that's why the spread is quite high. Now, it's not ideal company for option trading. But IV is not quite low as well. It's 2 point. If you look at CVS, I think last time when we look at CVS, it was 0.9 or 1, something like that. It wasn't close to 2. It's already 2 here. So the premium is high. So if you got $2.9, you would get about what? On that, about 3% or 5% on the profit here. But because of spread, you're going to only get $2. Still $2, it gives you about 2.1% of profit. If you bargain here and you get more, you might get up to 5%. So if it goes to, let's say, $2.5 and you manage to get $2.5, it's already going to be what? 5% on the trade. Okay, so that's the what I explained. So it's spread that kills everything here, and we're going to look now at buying calls because the idea is very good, but we need to see the strike spread. Okay, but still, if we make this trade, we can make this trade. Okay, and if you do it, so you bring the price to $53, right? So if the share price stays below 55 and you got $2, your actually share price going to be 57.50 55.75 minus $2, it would be 53.75. That would be your average price. With the commission is 53.76. Okay, you leverage your price down. So you can do this way, okay, if you don't want to wait. Or you can sell puts. If you sell puts, same strike prices, but look at this. If you use $50, nothing is there. 25 cents. Right? You put as a deposit $50,000, like $50, and you get on 25 cents. It's what? 0.5%. Definitely not a good trade. If you're using $60 strike price, so you promise you buy above current price. You're promising to buy $4.25 higher at the current price level, but you're getting only $4.30. So it's like 5 cents profit. Definitely not a good trade. And again, it is happening because the option interest, open interest is quite low here, and the bid is huge here, bid and ask gap. So the only option probably which could be used here, it's a $55 strike price, and you can get it $1.15 on that. So in this case, you will bring your average price down to 55 minus $1.15 is 53.85. So somewhere like that. Okay. Now with commission, it's probably 53.98. Okay. That's what you can expect on that particular case, and it will give you about 2.1% profit on the trade if the share price is above $55, which is quite possible. Okay, if it's below, your average buying price is in the range of $54. Okay, that's about puts. Is everything clear here? Nona, Ian, Dory. Okay, great. And now let's have a look at buying calls, like Dory suggests. So first of all, it's only January 2018. There is no January 19, right? 2019. So spreads again quite big. Look at the difference between bid and ask: $10 and $7.70. So it's $2.20 here, $2.30 here. At $55 here, it's what? 80 cents difference here. 80 cents here. 80, $1.10 here. So quite huge difference between bid and ask price. If you remember CVS Health last time, I think it was 10 or 15 cents only, the gap between bid and ask. So it was much lower. Now, why it is important? Because imagine that we are planning to make money on a growth, that the call will grow in price. Let's have a look how much it should grow in order for us to make a break-even point. So assuming that we, for example, take $55 strike price and you purchase it for $6.60 now, and we have a delta 58 cents. We have here the difference 80 cents. So how much share has to grow in value in order for us to cover this gap? Approximately. You don't have to be exact. So it's, that's 80 cents. And here is 58 cents. So it's the option price will grow up 58 cents for each dollar which is growing. So we need to cover 80 cents. So the share price has to grow to about $1.50. Okay, the share price goes from current price to $1.50, and in this case we can sell it at the price we buy it, and only after that we start making money. Okay, so that's why probably it wouldn't be the best trade which can make, because if it's going to go down and you want to put a stop loss, so yeah, it has to go to 58 in order to have a break even. And only after that you start making money. Okay. And we look, Nona suggested that at the current trend, on downtrend, if we do it now, it can go to 59 and then return and move back down to like $51 or $52 level. So that's why it wouldn't be perfect. But it can change. It can change next week. If for whatever reason people start feeling more about this company, more people start trading this company, you might see the gap narrows down and you might get it. So it's not always like that. I believe some companies, they're always like that, but some companies, they change. People move from one place to another. Remember about that. So that's why it has high option premium. So for buying, imagine it's like if you pay $6.6 for $55 strike price, it's what? It's more than 10%. Okay, so if you buy at the money, so which is not perfect for us. So nearly 13% here you're paying. So it's not perfect. So we're trying to get under 10. So about 7-8%. That would be the average where we're trying to get it. The next one, spread, very wide spread between bid and ask, not good for us, especially if you're value like option trader, you buy and sell them. Then $5 difference between strike prices, not also good for us, and low level of open interest. Here it actually doesn't show any open interest at all. So if you compare to the previous CVS Health, there was a very different situation there. So that's why CVS allowed us to make the trade. Actually, I'm looking at maybe to do something like that again, but CVS now it looks like on a downtrend and indicators not in the right place yet. So I'm going to pay attention to that. Okay, so it doesn't look like a good strategy for now, especially for ABG right now. Okay, guys, do you have any questions? Okay, perfect.